we got a lot of reports. We heard from a lot of the discount retailers. You have a new buy on a stock that's having its best month since November. It's up 12% month to date, and it is
Deckers. I've never owned it before, actually, Scott.
Well, why now?
Well, why now? It's because they have very strong brands. I'm a big believer in Hoka myself personally, but the numbers speak for themselves. It's growing Hoka about 20%, and they're guiding double-digit growth for the rest of the year for Hoka. UGG actually saw a massive snapback of 19% growth last quarter versus 3% the prior quarter. So they're seeing brand momentum. That's what I like to see in retail. They have great global opportunities to gain market share. International last quarter grew 50%. I think they're just at the tip of the iceberg in terms of international momentum. DTC, they have opportunities as well. And we are hearing, we've been talking about the China consumer. We are hearing that China is seeing a little bit of an improvement. 8% of Hoka's revenues have come from China. And they also talked about how the July and early August trends were off to a good start, beating expectations. So stocks trades at 17 times forward estimates, still down 41% on the year, down 25% in the past year. I think there's a catch-up trade to be had here.
Well, UBS agrees with you because UBS today is bullish as well, and they say this stock is a significantly underappreciated growth stock and that they see a, quote, very good opportunity to buy shares in a growth company currently significantly undervalued by the market. Certainly, tariffs could drive a macro slowdown, which disrupts the second half of next year. However, we view these as minor risks, which don't dull our enthusiasm for the big picture story. Any other takers? Deckers?
Quite a chart, though.
Crickets?
Yeah, no, that's quite a chart, though. It looks like it is bottoming and turning.
And there are only 14 buys out there from the sell side and 15 holds and sells, and you know that's right up my alley.
It's up 9% this week.
Yeah.
What's up with Gap? How about the price action? Can we look at Gap after they missed their comps? Tariffs are going to hurt profits. They maintain their full-year growth guide. Maybe that's why this chart that we're going to show you looks the way it does. So goes down, then comes back, and now it's up 2.5%. You own the stock. What's up with the price action? What does that tell you?
Because the headline comp miss is disappointing, but it was all Athleta. It was down 9%, and that was actually pretty much known. They have a new manager, actually, at Athleta intra-quarter, so they need to fix that. Athleisure overall is really struggling. It's not just Athleta. But in the meantime, 70% of their revenues come from Old Navy and Gap, the brands, and they're seeing nice comps. 2% at Old Navy, 4% at Gap, 4% at Banana. That was a big surprise. Now, the disappointment is tariffs and what it means to margins. I was thinking you can see operating margins by the end of this year at 10%. That's off the table because of tariffs. But 6.5%, 7% is still an improvement, and I think we will get through tariffs. The big deal in my mind is they have the products that they want. Richard Dixon is doing an amazing job with his new management team, and the stock is still trading at about 10 times forward estimates. So I think you have to be patient, though, for the operating leverage story to really pan out. But I do like the fact that the top line and same-store sales is beating.
All right.